Welcome to ValueVest Daily. So CES 2026 just wrapped up, and yeah, the headlines were buzzing with all the AI mirrors and smart rings. But while most people are seeing cool new gadgets, we're seeing something much, much bigger. A massive market shift that's just getting started. Today, we're going to peel back the layers of hype to find the real, undervalued companies that are set to absolutely dominate this new era of wellness tech.
All right, let's just cut to the chase, because this number right here, this is the heart of our entire thesis today. The global health tech market is on a rocket ship trajectory to hit a staggering $2 trillion by 2030. You see, all those gadgets we saw at CES, they aren't just toys. They are the canaries in the coal mine, signaling a huge economic shift. And the best part? They're being built by public companies with real products and, more importantly, real growing revenues.
And look, this isn't some pie-in-the-sky prediction for decades from now. The momentum is building as we speak. Just last year, in 2025, the wellness tech sector shot up by an impressive 15%. This isn't random. It's being fueled by these unstoppable forces, aging populations that need better health monitoring, and this huge cultural pivot towards proactive health. People using data to optimize their own biology, biohacking. The engine is already fired up, and believe me, it's just getting warmed up.
So to help you make sense of this whole thing, here's how we're going to break it down. First, we'll dive into that $2 trillion revolution. Then, we'll lay out the value investor's case, why this is so much more than just another tech trend. After that, the main event, a deep dive into 5 specific stocks we're watching. We'll even compare them side by side, map out a portfolio strategy for you, and then we'll wrap it all up with our final thoughts and the risks you've got to keep in mind.
Okay, let's jump right into Section 1, Wellness Tech's $2 trillion revolution. And the subtitle says it all, right? We're talking about the journey from CES hype to a real, tangible, multi-trillion-dollar market. You see, CES is like a crystal ball. It shows us exactly where people and businesses are going to be spending their money years down the road. And what we saw this year, it wasn't just a small step forward, it was a giant leap.
So what were the actual head turners on the floor? Well, we saw next-level wearables that do way more than just count your steps. We're talking medical-grade accuracy for stress and sleep. Then you've got these mind-blowing AI-powered mirrors from companies like Neurologics. They literally analyze your face to estimate your blood pressure. This is a huge deal because it's moving diagnostics from the doctor's office right into your bathroom. We also saw incredible exoskeletons from Hypershell that are no longer just for rehab, they're for everyday people. And tying it all together was AI, powering everything from nutrition trackers to glucose monitors that give you personalized advice in real time. This is the stuff that's going to define our lives for the next decade.
But what's really jaw-dropping here is the speed of this growth. I mean, think about it. We were already looking at a massive $200 billion market in 2025. Then CES this year basically screamed that mainstream adoption is here. And the forecast? A jump to $2 trillion by 2030. That's a potential 10x explosion in just 5 years. For any investor, that kind of growth curve is a massive flashing green light that something truly fundamental is happening.
Okay, let's move into Section 2 and talk about how this all translates into our core investment case, the value investor's thesis. This is where we separate the shiny objects from the solid fundamentals. And the key idea here is that this isn't just another risky tech bet. We actually see this as a defensive growth opportunity.
So what's really pushing this thing forward, beyond just the cool gadgets? Well, there are 4 huge drivers. First, plain and simple, demographics. The 65-plus population in the U.S. is going to jump by 30% by 2030. That is a massive, built-in customer base that needs this technology. Second, you have what's happening in pharma. The explosion of GLP-1 drugs, like Ozempic, is creating this huge parallel market for tech that helps people track weight loss and manage their health. Third, AI is making all of these solutions hyper-personalized, which makes them super effective and really sticky. And last but not least, health spending is basically recession-proof. People will cancel their vacation before they stop spending on their health.
In this slide, this is where the rubber really meets the road for us as value investors. The wider tech sector is trading at a price-to-earnings ratio of about 25. That's pricey. But the companies we're zeroing in on, they're in this beautiful sweet spot, around 15 to 20 times earnings, and they still have the potential for over 20% earnings growth. See what I mean? You're getting incredible growth potential without having to pay a crazy speculative price for it.
This quote just nails it, doesn't it? We truly believe that wellness tech is at that Polaroid moment, that perfect tipping point, just before it becomes an essential, non-negotiable part of our daily lives. The tech is finally there, the demand is undeniable, and all the data is pointing to mass adoption. For anyone looking to invest early, this is the moment. All right, now for the part you've been waiting for. Section 3, 5 stocks to watch. We're going to do a deep dive into the specific companies that we believe are in the absolute best position not only to power this health revolution, but also deliver serious value back to their shareholders.
First up, we've got a name you probably already know, Abbott Laboratories, ticker ABT. I like to call them the glucose giant going AI. Look, this isn't some flashy startup. This is a stable, defensive, med-tech behemoth that is brilliantly using cutting-edge AI to lock down its market leadership. It's the kind of company that you build a solid portfolio around.
So let's pop the hood and look at the numbers. At first glance, a PE of 24 seems fine, pretty fair. But then you compare it to a competitor like Dexcom, which trades at a PE of over 50. Suddenly, Abbott starts to look incredibly undervalued for its dominant position. You're getting a market leader at a really reasonable price. Plus, they'll pay you a solid 2.1% dividend while you wait for that growth to kick in. We see this hitting $140, which is a nice 15% upside.
So what's the big CES catalyst that unlocks all this value? It's their new system called Libre Assist. Get this, users can just snap a photo of their meal and the AI predicts exactly how it's going to impact their glucose levels. This is an absolute game changer. It creates what we call a competitive moat that's almost impossible to cross. The more photos it sees, the smarter the AI gets, making it a nightmare for anyone trying to catch up. With 1 in 10 Americans dealing with diabetes, this ecosystem could easily tack on an extra $5 billion in revenue. That's why we think it's a steal at this price.
All right, number 2 on our list is Garmin, ticker GRMN. We see them as the established leader in wearables that's now leveling up its game. They've already built this incredible brand in the premium sports watch market, and now they're doubling down on their software to build an even stickier ecosystem.
Now, the financials here tell a really interesting story. The stock's actually down a little bit over the past year, which for a value investor is a huge blinking light that says, pay attention. It's trading at an attractive PE of 22, and what's really impressive, it's gushing cash. Over $1 billion a year in free cash flow. That is a massive war chest to innovate, to market, or even to scoop up some of the smaller startups we saw at CES. We see this heading to $250, giving you a potential 17% upside from this recent dip.
Garmin's big splash at CES wasn't a new piece of hardware. It was smarter software. They've built voice-logged nutrition and AI coaching right into their Connect app. And this is so critical. It transforms them from just a device company into your full-service health partner. It makes users way more engaged, sure, but the real prize? It opens the door for premium subscriptions, creating a high-margin, recurring revenue stream right on top of their watch sales. Brilliant move.
Okay, our third stock is, well, it's a totally different animal. This is ZEPP Health, ticker ZEPP, and this is our high-growth underdog. This is the speculative play for the more aggressive slice of your portfolio. It's a small-cap company, but man, it has the potential for some absolutely explosive growth.
I mean, just look at that one-year performance, over 685%. That's just wild. And yet, it's still a tiny company, with a market cap well under $400 million. But here's the kicker, the most compelling part. Even after that insane run, its PE ratio is only 15, and it still has the potential for over 50% revenue growth. That is a deep, deep discount. We've got a target of $40 here, but you have to remember, with this kind of growth comes a ton of volatility, so you gotta size your position accordingly.
And finally, we have to talk about the elephants in the room, Apple and Alphabet. They might not have had giant booths at CES, but trust me, their fingerprints were all over the event. Why? Because every single new health gadget out there is being designed to plug right into their ecosystems. They own the platforms, they own the data, and that makes them the ultimate gatekeepers to this entire market.
For Apple, it's all about that famous walled garden. The Apple Watch is the Trojan horse that pulls users into their health and fitness plus services, and those services are growing at over 20% a year. The cost of switching away from that ecosystem is just huge. Alphabet, on the other hand, is playing a slightly different game. They're using Fitbit to gather data from the masses, while their super ambitious Verily division works on moonshot projects and longevity. Yeah, their valuations are higher, but what you're buying is unmatched scale and platform dominance. They're playing the long game to own the future of all our health data.
Okay, so we've met the individual players. Now for Section 4, let's put them all head-to-head so we can really compare the contenders. This is where you can see how they all stack up on the metrics that matter most to us as value investors.
This table really pulls it all together. Let's just focus on a couple of things here. You see Abbott and Google with that high value score of 9, representing those stable, dominant plays.
Now slide your eyes over to the PE ratio column. Look at ZEPP, all the way down at 15. That's just remarkable for a growth company. Then there's GRMN at 22, which looks really attractive when you see its negative performance for the year. That could be a great entry point. Honestly, this table is your cheat sheet for seeing the relative value in each of these opportunities.
Okay, let's move into Section 5 and actually build a plan. Because knowing about the stocks is one thing, but it's another to know how to build a smart, resilient portfolio strategy that positions you for that sweet, long-term compounding.
We recommend a really simple 3-step approach. First, you establish your core. That means putting the bulk of your capital into the stable, blue-chip leaders. Think Abbott or Google. Step 2, add a growth kicker. This is where you put a smaller, calculated bet on a more speculative name like ZEPP Health to try and capture that explosive upside. And step 3, and this is so important, set a time horizon of at least 3 to 5 years. This is not a get-rich-quick trade. This is about letting these massive trends play out and compound your wealth over time.
And here's a visual of what that could look like. For example, a 60-40 split. 60% goes into your blue-chip core, your Abbotts and your Googles, and 40% is allocated to your growth-oriented names like ZEPP and GRMN. This approach gives you this great balanced exposure. You get the stability of the giants and the high-octane growth potential of the challengers. It's all about capturing solid returns while managing your risk.
We're in the home stretch now, and that brings us to our final, and maybe most important, section: final analysis and risks. No investment idea is complete without taking a hard, clear-eyed look at what could possibly go wrong. So let's cover the big takeaways and what you absolutely need to be watching out for.
Look, every opportunity comes with risks, and you have to go in with your eyes wide open. For wellness tech, the big ones are regulatory hurdles. FDA approvals can be painfully slow and unpredictable. The competition is absolutely fierce, from tiny startups to the biggest companies in the world. There's also the danger that market hype gets way ahead of reality and pushes prices too high. And of course, a big economic slowdown could hit people's wallets, especially when it comes to buying premium gadgets. You've got to keep these on your radar.
So, to wrap it all up, CES 2026 gave us so much more than just a peek at some cool future tech. For us as investors, it gave us a clear roadmap to where a multi-trillion-dollar market is going. We believe the 5 companies we talked about today are in a fantastic position to ride that massive wave of wellness wealth. But now, I want to turn it over to you. After everything we've covered today, which one of these CES-related stocks has caught your eye? Are you leaning toward the stability of an Abbott, the wild growth of a ZEPP, or maybe something else entirely? Drop a comment below and let us know what you're thinking. And of course, we've got to say it, this is for educational purposes only and is not financial or tax advice. Please always do your own homework before making any investment decisions. And hey, if you found this breakdown valuable, do us a favor and subscribe, like, and share ValueVest Daily. It helps us bring you these learning opportunities every single day. And one more thing, if there are any specific high-risk, high-reward opportunities you want us to do a deep dive on, let us know in the comments. Thanks for watching.